First, Bloomberg.
Welcome back. This is Bottom Line on Bloomberg Television and streaming on your tablet, your phone, and Bloomberg.com. A mixed picture for the U.S. housing sector in July. Builders broke ground on more homes, pushing total housing starts up by 50,000 to 896,000. But there was a slowdown in the start of single-family homes, which fell 2.2% to an annual rate of 592,000. Real estate attorney Shari Olefson is the author of Foreclosure Nation. She joins me here in studio. Welcome back to Bottom Line. Good to see you again.
Thanks for having me. Nice to see you.
The rise we saw last month, it was due to multifamily construction,
yes.
Apartment buildings. Are rental units driving the gains we're seeing?
For the most part, they are. We know that folks are still having a hard time getting loans. We've added more rental households in this country than we have in any time in recent history, and so that's where we're really looking at. In terms of builders, they're focusing on the multifamily.
But this slowdown that you just spoke of in the single family, how does that contrast with the surge in builder confidence that we're seeing? It seems counterintuitive.
Well, it does, but most of our builders, again, are focusing on the multifamily. The problem is that lending is easing up for the builders, but for the end home buyers, it's not. And oftentimes we're talking about first-time home buyers, but one of the things we're seeing, Mark, now in the last month or so is a little bit less the story being about investors in the single-family home sector and a little bit more about inventory freeing up a little bit. So hopefully we're going to see more buyers getting back into the market.
You just spoke of home builders. How much are they going to benefit from the constrained supply of existing homes, not to mention that borrowing costs are still at historic lows?
Well, that's a problem, and that's something that we're going to expect to see continue. I mean, we're coming up against January of 2014 when a lot of these new rules start kicking in, including the qualified mortgage rules under Dodd-Frank. It's going to get tougher. Already we're seeing government contraction. We know where there's a lot of talk about GSE reform, reforming Fannie and Freddie. Already they have about 10% less of the purchase money mortgage market share right now. So it's going to get tighter for borrowers, not looser.
I was reading some of the information that you sent to our producers, and you outlined some very hard truths. The housing sector has been showing signs of life, to be sure, but 10 million homeowners are still underwater.
That's
Another
correct.
6 million are in default, and home prices are 25% under their peak. What is the relief for those homeowners?
Well, about 2 million homeowners became underwater last year, so they rose above negative equity, and that's going to continue to happen as the home values rise. The problem really is with those first-time buyers, because we're looking at folks under 30 generally. They're having trouble getting jobs, they're having trouble saving a down payment, and unless they can buy the existing homes, no one can move up. That's one of the reasons we're not seeing builders building a ton of single-family homes.
How much down payment are they being asked to put down?
Well, for FHA, you need 3.5%, but you know, some of the new rules coming out, the proposals out of the House and Senate for reforming the GSEs and FHA would, for example, raise that down payment to as much as 5%. The other real issue, though, for those first-time buyers is this past month, FHA changed their rules. So it used to be that you only needed mortgage insurance until you reached a 78% loan-to-value, and then the mortgage insurance went away. For most first-time buyers now, they're going to have mortgage insurance for the life of the loan.
Average rate on a 30-year fixed loan this week, 4.4%. That is a full percentage point higher than it was in early May. Higher loan rates, are they starting to weigh on housing?
That's correct, and that's something that surveys are showing that buyers are concerned about. Believe it or not, surveys are also showing that sellers are concerned about that, because of course the more money buyers are paying towards their mortgage, the less they can pay for homes, which may affect home values. But the truth is that rates would have to get up to 6 or 7% to really have an impact, because housing is so affordable.
The Fed's monthly bond purchases, they kept long-term interest rates low. If the Fed starts to taper those purchases next month, how's the housing sector going to react, do you think?
Well, it could, of course, impact rates, obviously. But the other big issue is that the government is really trying to get the private sector into the secondary mortgage market.
Yes.
And the last thing investors are going to want to do is invest in 30-year fixed-rate mortgages when interest rates are going up.
Should the government have a role in housing? And if they are eliminated, if you will, from the mortgage market, is the private sector going to be the backstop?
Well, look, that's an interesting question, because here the president's proposal, the proposals in the House and Senate are all saying we need to get the private industry into the market, but at the same time they're saying we need to get taxpayer money out because it's not safe.
Sure.
So it's real interesting to see how they're going to sell the private sector on it. Well, they're saying it's not safe for taxpayer money.
If the government is out and it's the private sector's game, small and community banks, how will they be affected?
Well, it's going to be tough for them to compete with the biggies who will be able to presumably control the market and create a lot less choices for consumers. But again, some of the proposals, particularly the House proposal pending right now, which is the PATH Act, does provide for special treatment for smaller banks so that they'll be able to compete.
Real estate attorney Shari Olefson, author of Foreclosure Nation, joining us on site. Good to see you again.
Thanks, Mark.
for coming
Take care.
in.